I think this is a very important mindset. Financial advisors are not there to make you wealthy.
They moved to the UK at almost exactly the same time as I did to open our UK office, and the guy that had been looking after them had actually moved on. And they had a tiny little savings plan that we'd set up for them in Guernsey and a small investment.
What about the future? What about the future of the financial service industry?
Well, before they come on to the future, what do you think about the impact of consumer duty on the market at the moment?
Well, I thought, in my naivety, that RDR was going to do what consumer duty has done.
Yeah, exactly.
I don't know, because I've never asked anybody at the regulator, but I have a sneaking suspicion that were we to ask the people at the FCA at the time, they probably thought RDR was going to do what consumer duty has now done.
Yeah,
I think it's absolutely right, the way that it is focusing attention on the fact that there is a cost associated with looking after your money. Is the person who is receiving the fee from that delivering to your expectations? And I mean, a lot of people completely ignorant of the fact that they should have an expectation.
Yeah.
I mean, I like to think that wasn't the case with Michael. And perhaps if we sat them all down, there'd be one or two hands go up and say, "Well, we didn't quite get what we thought we were going to get."
Mm-hmm.
I don't know. I mean, I'm pleased to say I haven't seen a raft of complaints running around. So, so I think it is a good thing. As with all bits of regulation, we usually find the pendulum goes slightly too far. And maybe we're seeing the regulator looking at it, and I mean, I'm pleased to see that they're reviewing themselves as well as they are reviewing and regulating what advisors and businesses are doing generally. But I think it feeds into that point about the future, which is that technology lies at the heart of all of this.
Yeah.
I mean, I like to think that, if we were sitting here in 15 years' time, maybe. Well, let's go really simple. If we were sitting here in 40 years' time, will people be able to get a fully digitized financial services program, financial advice, financial planning? Well, absolutely they will. Will that happen in 10 years? Will it be 5 years from now? I mean, I don't know. But given the fact that the average age of a financial advisor in this country is still closer to my age than yours, and something like 20% of the IFAs in the country are proposing to exit stage left at some point in the next 4 to 5 years.
Yeah.
Despite the success of the academies and that a lot of the bigger businesses and smaller IFAs have put in place, there's nothing like the right replacement rate.
Yeah.
So demand for advice is going up, and the number of people capable of providing it is going down in real terms. So technology's got to play a bigger and bigger and bigger part as we go along. And my gut tells me somewhere that despite the fact that we all prefer, humans prefer the peace of mind comfort of having a human to interact with when it comes to making big financial decisions, that there is a generation or two of younger people for whom that's less of a problem. And AI tools are becoming incredibly sophisticated. So for me, I see the steps between that fully digitized thing and where we are now is a form of hybrid advice. So an advisor able to deal with way more clients than they've been able to deal with before through really good software, virtual meetings, delegating some of the data input to the client.
Yeah.
There's plenty of financial planning tools now where you can send a link off to the client, they register, input their own information, build your basic sort of fact find and know your client info. They can even go through an investment risk analysis. They can put in their expenditure, all of their assets, etc., 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 leaving the advisor in a position to have a fairly decent picture of what they look like without having to drive halfway across the country, taking half the day to do it, spending 2 hours then handwriting in a form or perhaps typing it into a thing. And so you can cut all of that nonsense out, and it'll only be probably the more complicated situation and wealthier situation where actually it demands the advisor is there at the get-go. How fast that process takes, I have no idea.
Yeah, so I think I agree with a lot of that, Mike. I think this is a very important mindset. Financial advisors are not there to make you wealthy at all. In fact, our clients do a bloody good job in making themselves pretty wealthy. It's our job to actually preserve that wealth as much as possible. So when it comes to investment returns, X, Y, and Z, no, Mr. Client, it's less about that. Okay, in terms of investing in yourself, you're probably going to get a far greater return. Okay, where to put your funds, how to structure your funds, how to structure your assets. Okay, that's a completely separate conversation to make the best out of the market that you have available to you.
I was but my first business was based in, which is when I was in Guernsey, Channel Islands, and I had a colleague who looked after this couple. They were clients of his, but they moved to the UK at almost exactly the same time as I did to open our UK office, and the guy that had been looking after them had actually moved on. And they had a tiny little savings plan that we'd set up for them in Guernsey, and a small investment. Husband and wife. Husband worked for an energy business that had a decent share option scheme, and they IPO'd in, I think, 96, 97, somewhere around there.
Yeah.
And he got a reasonable amount of money out of that. He had, much to my frustration and my former colleagues in Guernsey, taken out a large critical illness policy with his bank. And the commission involved was quite sizable, and I remember being really a bit annoyed that he'd done that with the bank and not spoken to us.
Yeah.
Sadly, 2 years later, he was diagnosed with non-Hodgkin's lymphoma.
Oh my.
And the policy paid out.
Yeah.
And it was a big number. And he said, now what do I do? I mean, he went to hell and back through the treatment, survived. Sadly, had it again a few years later. But the wealth that actually they built up, we had virtually no input.
Yeah.
We looked after it and managed it and made sure it stayed safe, looked after various elements of it, planned for his their wills and estate, and planned for what would happen in the event of his death, but also bearing in mind that despite his illness, there's no law out there that says he was going to die first.
Yeah.
I mean, as it happens, he did, but I've come across situations where the reverse has happened, where the person who's the illest survives, and so it's just crazy how much money we ended up looking after.
Yeah.
That we had no input into creating.
Yeah. No, but you may not have had input in creating, but I would say once you've got that particular windfall, or if they had received that level of advice, then the type of decision the advisor would make would be, look, if you do receive a windfall via a life policy, whether it's a critical illness policy or your beneficiaries from a life policy, it needs to be via trust.
Mm-hmm.
But then what type of trust, which is another important consideration. And then when it comes to having the trust populated, it's about knowing how to manage the underlying trust as well.
Mm-hmm.
So I think also when it comes to, I'm just thinking about the type of ongoing advice that me and Prajesh give. I mean, there's one particular client who has us on a retainer. I mean, very, very ambitious, successful in his own right. He's non-UK resident, living in South Africa right now, joined up with a couple of other very successful shareholders. Now, they're setting up a new business. They need advice on which jurisdiction to set up that practice, or that particular trading company. Is it going to be in the UK, where one of the shareholders is? Is it going to be in South Africa, where the founder is? Is it going to be in the USA? I can guarantee you, if they make that decision, if they had made that decision themselves, 9 out of 10 times it would be the wrong one.
Mm-hmm.
But because we're on a retainer with them, because we're managing a whole load of other stuff, they're gonna get the right advice, because we've got that type of relationship where we can actually provide tax advice on matters like that. But there's a plethora of other scenarios as well, okay, where the access to professional advice, right, whether it's in-house or whether your advisor is smart enough, resourceful enough to put you in touch with the right type of competent professional, it's going to save you millions upon millions upon millions, either during your lifetime or on death.
Yeah. People have a frustrating habit of moving.
Yeah.
They'll go from one jurisdiction to another and causing complete mayhem.
Oh, yeah.
Or marrying somebody from two different nationalities, and then it's just.
Oh yeah.
And right now,
yeah,
I don't think large language models are quite capable of.
Oh yeah.
Of disseminating all of that and working out what might be best for the client. The clients, what a really good financial planner can do is, I always used to call it to stick the pin in.
Yeah.
So ask the awkward question to get the clients to think about where they want to be, where they might be.
Yeah.
In an ideal world.
Yeah.
Where they might be and what they would do in a kind of a variety of what if scenarios.
Yeah.
Pull all that back and say, well, okay, taking that into account, we need to do X, Y, and Z to plan for your future. And if it is multi-jurisdictional,
yeah,
do we base your wealth, your assets in? But if you think of it like a wheel,
yeah,
and we put your affairs in the hub, which could be trusts, foundations, family investment companies, combination thereof, and you can spin around the outside to your heart's content.
Yeah,
the money stays there, provided, of course, it's in a politically stable environment.
Yeah,
where the rule of law is preeminent.
Yeah.
It helps if it's tax favorable as well.
Correct. Liquidity.
Liquidity.
Yeah.
You mentioned earlier on about asset allocation, and again, you can't get this through robo advisors.
Yeah.
I used to draw a pie chart.
Yeah.
To clients, and I say, depending on which Sunday newspaper you read, you could be forgiven for assuming that one asset class is superior to the others.
Yeah.
Well, it's absolute nonsense. That you need to invest in all of them. The question is, what proportion?
Yeah.
Relative to where you are now, and and that will change and evolve over time.
Yeah.
And I think it was partly because of the way interest rates were going that I then actually started to say about cash.
Yeah.
Was that actually the most important piece of your wealth that when it comes to making the decision is the amount you don't invest.
Yeah.
Because that's what sees you through the inevitable volatility of stuff. Because I was at a conference 2 years ago in the US, and I was talking to I've been invited to go.
Yeah.
And I was pinching myself, thinking, why on earth am I here with these ridiculously wealthy people? And this one guy who, the family business is worth billions.
Yeah.
And he was talking at breakfast to another chap who I briefly met once. We'd ended up, you know how they have these sort of golf buggy carts, they take you around to chuck you out at your room, and he and I had shared a buggy ride, so that's how I met him. And we were sitting there, I was listening to this conversation, and I said, look, can I butt in?
Yeah.
Bear in mind how wealthy this guy is. And I drew the pie chart I was talking about, and the cash bit.
Yeah.
And because they were, I can't remember what investment it was they were talking about, but flapping and worrying about the fact that they might have, on paper, lost a fortune.
Yeah.
And I said, well, the most important bit is the decision how much you don't invest. That's the critical decision.
Yeah.
Get that right, the liquidity, and it doesn't matter what happens to everything else.
Yeah.
Because you've got the emergency money you need to soften all of those things and carry you across.
Yeah.
And humans have always been driven by fear and greed.
Yeah.
And the propensity to overinvest. And I do worry that things like robo-advisors will encourage it.
Yeah.
Certainly financial influencers will encourage it.
Yeah.
And crypto and all, it just, there is a risk of going too mad.
Yeah.
Sure, cash is, you get poor returns.
Yeah.
You lose money against inflation. But for me, the way to look at it is it's like your loss in value on cash is just the insurance premium you're paying to make sure you won't go bust when things go pear-shaped on you in 5, 6, 7, 15 years' time.
Spot on.
I remember seeing a graph showing the potential trajectory, I mispronounced the word, of the advancement of AI.
Mm-hmm.
And the next big milestone, which all the big tech companies are working towards, is artificial general intelligence, which is when AI can fully replace a human completely. So I think we're all safe until that moment in time.
Hope so.
But we've discussed a lot of really interesting topics today. I hope you found it really insightful, and tune in next time for the next episode.
Great. You will be seeing more of Mike as well. Mike will be undertaking several coaching programs, so watch this space, guys.